this is part 2 of the video on the ESPPs. The previous video went into the basics of the ESPP. This one, we're going to talk more about the tax elements and how ESPPs are taxed. ESPPs can get a little complicated when it comes to taxation. So this is just a basic video. Always, it would be always advisable to talk to a CPA who is well versed in the ESPP space whenever you have an option. But let's see some of the things that we need to consider when it comes to ESPP taxation. So 3 basic things or rules to remember on the ESPP taxation. No tax at purchase. So when the company purchases the ESPP for you, there is no tax implication at that time. You have already put in after-tax money into the account that the company uses to purchase the ESPPs for you. So that's why no tax at purchase. There is no Medicare or Social Security tax that is withheld at purchase or at sale of the ESPP. Again, remember, you're using your own money to buy ESPP. It is not income for you. That's why there is no Medicare or Social Security tax that is withheld. And then the company does not withhold any income tax at sale when you are selling the ESPP. So you always have to make sure that whenever you have a sale, you keep in mind that you will be taxed whenever you are filing your taxes on those. So let's see how what are the elements for ESPP taxation. So there is 2 tax elements. As we know that we have ordinary income tax and then we have the capital gain. Depending on how long you hold your ESPPs and when you sell them, that's, you'll find that sometimes you'll have long-term capital gain, sometimes you'll have short-term capital gain. And the ordinary income tax will vary depending on how long you hold it and everything. So let's see how the taxation for ESPP works. And in this calculation, we are showing you a calculation for when the stock price is going up. Again, when the stock price is going down, ESPP might not turn out to be a really good investment and you might have some losses on it. But let's see a simple example of when the stock price is going up. So remember, in ESPP, there's a couple of dates that we discussed. One is the offer date, then is your purchase date. So offer date is just when the company offers you to participate in the ESPP plan. Then purchase date is actually the date of the purchase when the company buys the shares for you. So if there is a look back period, usually what happens is that in this example, if the price of the company stock was $10 on the offer date and on the purchase date, the price of your company stock is $15. If your company has a look back period and a 10% discount, so you will get a 10% discount on the $10, which is the price on the offer date. So you actually get to purchase purchase a share for $9. So 10% discount on $10, that's your purchase price. Now you can decide. The purchase price is $9. The company stock is $15 on that day. So you can totally say that I want to sell the share on the same day, lock in the $6 in gain, and that $6 would be all ordinary income tax. You don't have to worry about how long should you hold the ESPP, how long should you keep it. All you did was lock in the gain. So that would be all ordinary income because you just sold it the day it happened. Now, but if you decide to keep it for a longer period, let's see how tax works. So there is 2 things that you have to remember. One is a disqualifying disposition and a qualifying disposition. So a disqualifying disposition is when you sell the company stock or your ESPP less than, if it hasn't met the holding period, which is usually 2 years from the grant date and 1 year from the purchase price. So anytime you don't satisfy those 2 requirements, it is a disqualifying disposition. So in a disqualifying disposition, the taxes are different than in a qualifying disposition. So let's see what happens in disqualifying disposition. So for example, now you purchase the share you held the share for 1 year after purchase, but you haven't held the share for 2 years from offer date. Now let's see in that case what happens. So if the price of the company stock on the date you decide to sell is $18, so in case of disqualifying disposition, what happens is that this whole $6, the difference between the price of the share on the purchase date and your purchase price, this $6 is going to be taxed at ordinary income tax. And since you held the share for more than a year after the purchase date, this $3 is going to be long-term capital gain because you have satisfied that 1 year holding period from the purchase date. So $3 is going to be long-term capital gain. So again, with ESPP, you can decide anytime you want to sell, it's just the tax treatment. Now let's look at the qualifying disposition, and this is where you will reap all the tax benefits of a ESPP when you do the qualifying disposition. So as we all know that ordinary income is your normal tax bracket, and the long-term capital gain is usually the preferred tax rate, which is depending on your tax bracket, could be 15% or 20%. So now let's see what happens in a qualifying disposition. In a qualifying disposition, now let's say if you held the stock 2 years from the offer date and the company stock is still doing great, the price is $20 on the day you decide to sell. So the way it's treated is that you will only pay $1 in ordinary income tax. So remember, you had a look back period to the offer date. So the difference between the $10 and the $9, which is your purchase price, is the only amount that's taxed at ordinary income tax. And if you sold the share for $20, then so 20 minus 10, the $10 is your long-term capital gain. So now you can see that you will owe less taxes because long-term capital gain is going to be less than your ordinary income tax. So this is where you get the full benefit of holding the ESPP. Now, again, you don't know what is going to happen to the company's stock. So your decision for how long to keep the ESPP should not be dependent on your taxes. It should be dependent on your whole financial plan and when you need to use the cash. So it is totally okay if you want to just lock in the $6 gain and not worry about the uncertainty of holding the stock for 2 years. So again, your decision will be dependent on your financial plan. But if the stock price goes down or if it stays the same, there's different tax implications, and it would always be advisable to talk to a CPA when you're selling ESPPs. Again, this video is not meant for personal financial advice. This is only for educational purposes.